This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Myers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self Storage Podcast. I am your host, Scott Myers, and this week's guest is Steve Parisi. Steve has been in the financial services industry since 2011 after graduating from Moravian College and gained experience in Medicare and finally expense insurance, and then as a case designer for high cash value life insurance policies. Then in 2015, Steve began an independent venture and started his own company, IBC Global Incorporated, in a garage with 2 desks and 1 part-time assistant, where he helped individuals set up high cash value life insurance policies. Since then, IBC Global Incorporated has grown into a full-functioning professional office with over 40 full-time employees. And when Steve isn't helping others, he spends quality time with his wife, Tara, and their dogs, and is an avid runner who also gives priority to his volunteer work, where he educates his neighbors about the Bible. So without further ado, please enjoy my wide-ranging conversation with our guest, Mr. Steve Parisi. Hey, Steve, good to see you again. Welcome to the show.
Scott, thank you for having me. Much appreciated.
Oh, it's my pleasure. I'm glad that we were able to connect as we continue to have these discussions with regards to the capital stack and ways that we can tap into additional capital to be able to put together these projects. This is a topic that has come up over and over again. This is a topic that we have used in various fashions, and that is, how do we tap into life insurance? Sometimes setting up our own policies, using our own policies, and the multiple ways. And really, as you and I discussed even before we got on the call, to sum it up, how the corporate folks use these life insurance policies to be able to grow their businesses, whether it's in real estate or outside of that. And so your name had come up over and over again, as we discussed, as the person that can break this down and make it real simple for our folks. And so with that, I've given everybody an introduction and a brief background on you, your history, and your company. But, if you would, why don't you fill in the gaps, and then we'll launch into, how our folks can use this strategy.
Yeah, absolutely. So quick background just on my company and such. Will do. So when I got into the industry back in 2011, started just in insurance sales, did horrible. My first 3 years, I made under 10 grand per year. So I was a struggling life insurance agent, if you want to put it that way. But after that, started working at other firms. And just to speed things up, to get to the point in this interview, is I picked up a role at a firm where my role was specifically designing policies for corporations. So it was at an executive benefit planning firm. The firm would set up what's called supplemental executive retirement plans. What these are cash value life insurance policies on the executives at corporations. The company owns the policies, so there's a form of key man insurance, but really what they're doing is beefing up the asset on the balance sheet by hyper-funding their cash value life insurance products. That's an asset they have access to from a cash value benefit standpoint. And then also they call it their own retirement benefit for their executives if the executives stay with the company. So during my time at that role, I had access to individuals, higher ups at home offices at some of the major mutual life insurance carriers. Very fortunate to pick up that role, just designing policies, learned all of the ins and outs. I like to think of it as a rookie quarterback sitting on the bench, just learning the offensive playbook for a number of years, and then was able to take that knowledge as I transitioned into my own role, which eventually became my company, just took the knowledge and basically showed individuals how to use cash value life insurance products just like corporations. What are the wealthy doing? What are companies doing with these products? Because that's what everyone wants to know. Firstly, how do I maximize the actual cash value assets? What should I know that corporations don't like? And then how do I use the policy, whether I want to use it for real estate, business, whatever it might be. But first and foremost, how do I maximize the cash value and flexibility so it doesn't feel like a boring bill? And then how do I use it? But that's just my time in a nutshell. I've been in the business for almost 11 years now. Actually, it's been 11 years this month. Look at that. I've lost track, but that's a short overview.
Great. Well, congratulations on getting to that place after 11 years now, and the course that you've taken. So let's talk about what this looks like for an individual. And for many folks, and maybe I'm just speaking for myself, but it's not a topic that we dig too deep into. It's more of we know we have to do it, we must do it. But this is, we're taking a different approach. to being able to use life insurance, which is something that we truly we don't have to have it, but we should have it. But now to be able to turn around and make it a benefit in our business. So let's say the small to medium sized investor either has insurance or they're not, or they're looking to go down this path. What are the things that they should be looking for and considering, regarding their personal scenario, whether it be on the life insurance side and investing, as to, those considerations that they need to, look into before they go down this path. And, what does that look like? Tell us what the interview looks like when you're working with somebody for the first time and guiding them down this path.
Yeah, absolutely. Great way you line that up too. Thank you. So with life insurance, the majority of people that we work with will often outright express that they do not care about the life insurance aspect initially. Long term, that does come into play and they see the value. But initially,
well, Steve, that's because us entrepreneurs, we are immortal. You knew that, right? And there's everything bounces off of us, and we're not going to die, right? We are the eternal optimists, and so that is the reason for that comment.
Right on. And what you'll get as a follow-up comment there too from many is, as an entrepreneur, I view the cash value benefit as the number one point of interest that I can use for my business. I want to be able to have access to as much capital as possible to continue to feed my business, because that's how I've grown it, with capital, with cash over time. So cash value life insurance, there's an appeal there. Often I'll lay out 3 core benefits, specifically focusing on the cash value. And those core benefits with a life insurance policy, this whole life specifically, is 1, that it's a safe area to position money, 2, that it's a liquid area to position money, and 3, tax-free. Tax-free if you do everything properly. There's ways you can mess that up. So to provide a little bit more information, this is often what attracts people to the cash value benefit. Safe, the net internal rate of return, the net growth rate over time, if a policy is properly designed, if it's positioned with one of the major mutual companies that we've seen proof of performance with, not just hypotheticals, the net growth rate will typically range between 3 to 5%. And the nice thing about that is that's consistent if things are going very, very well in the economy and market, or if things are going very, very poorly. Historically, it's done a little bit better, but where we're at right now in the low interest rate environment, properly setting expectations the same way we do for corporations, have to treat individuals the same. So that safety, 3 to 5% net IRR, peace of mind product, don't have to think about it, it's constant. The liquidity feature, this is really what attracts people, in the sense that once a dollar passes through the cash value of a life insurance policy, say it's earning a 4% IRR, regardless if I just let it sit and grow, or if I elect to borrow against it, if I decide to take loans, I'll continue to earn that 4% internal rate of return on my full cash value. Any money that is still in cash and what I have loaned against it. There's no lost opportunity cost. So many real estate investors relate with this because it's similar to an appreciating piece of real estate where I can take a line of credit or mortgage against it, but I still receive appreciation on the entire asset. With the product, a bit more liquid, easy to access, I've got guarantees that make it attractive. And then tax-free if I do things properly, if I don't trigger a taxable event. There's what's called a modified endowment contract. If I cash it out with a gain on it, there's taxes. But those are the core benefits that often attract people. That's why someone is interested in it. Any questions on any of that? Does that make sense?
Well, maybe a comment, first of all, and that is typically we're borrowing money from the bank at 4 to 5%. And now if we put this money in, even though it is our money, it's not like we don't have it when we go to a bank, but now we're getting paid 4%, even when we're borrowing against it, correct?
Correct. That appreciation is constant. Mm-hmm.
So as we look at and calculate our returns, you could typically factor that in, and that may factor into somebody's buying criteria or acquisition criteria. But okay, so with that, let's talk about the logistics. Then what does that look like as we have the value of a policy? It's worth X. How much can we borrow against it? What are the cons for doing so? What are the limitations? And what are the other gotchas perhaps that we need to look out for?
Absolutely. So your first question, how much can we borrow of the value? Whatever I have in cash value, typically I have access to that, depending on the insurance company and their loan interest rate, to set expectations properly. Between 93 and 95% of my total cash value I can access. Some carriers let you go up to 98 to 99%. but 93 to 95%, I know I can get that with just about any carrier. If I can get more, I'm happy. If I tell you 99, if you only get 93, you don't like me very much. So typically call it 95%. You hit on a good point as far as the net internal rate of return, 4%, and then also what you can get from banks and lenders, 4 to 5% if you're going to leverage a loan elsewhere. When it comes to using a policy for any type of investing, real estate investing, leveraging a life insurance policy because you get that constant compounding. The number one objection that I see with real estate investors more than anyone else is they're interested in the cash value life insurance product because of that constant compounding. But often where they feel that there's buyer's remorse, or I wish I would have known that before I dedicated my money to a policy, is when they hear a term such as an insurance company will pay you a dividend rate of 6% and you can borrow with a loan interest rate of 5%.
Assuming that it's favorable, then it seems like people would be interested in being able to, plow money into a policy. And, if you can do that or maximize that, because there are some benefits to it. So before we get to that and have you answering that, Steve, let's talk about the tax side, either tax benefits or tax consequences.
Sure. So cash value life insurance is tax-free if we do everything properly. So a whole life insurance policy, when I am funding it with premium dollars and also PUA dollars, that stands for paid up additions. I like to refer to it as a cash dump in because I see that money in cash value immediately, just about all of it. Any payments I make are made with after-tax dollars, similar to a Roth IRA or Roth account where I cannot deduct the payments I make toward life insurance policies. I can if I put it in a qualified account, but typically payments I make are made with 100% after-tax dollars. The growth, per the IRS language, is technically tax deferred. So when I see a gain in cash value, more money than what I paid in, I'm not paying taxes on that. However, I can access my cost basis, the money I paid in, and the gains in the policy completely tax-free if I do so properly, and I can always withdraw up to my cost basis or take loans up to my basis and above and beyond. Policy loans are not taxable. That's the advantage right there. And then another layer to that, which doesn't have much to do with taxes, but when you and I hear the word loan, typically we think payments and interest, or the average consumer, that is. With life insurance policies, you do have complete control. There's a loan interest that accrues. However, you are not required to pay that back unless perhaps we loan everything and our policy is about to lapse, then we will have to pay something. But that's fairly easy to prevent, and providing awareness upfront helps with that. But if we do everything properly regarding how we pull money from the policy through withdrawals and loans, we can access all of it tax-free. There's also what's called a MEC, a MEC, modified endowment contract. Any life insurance policy can become one. If it does, when we access the cash value, we have to pay income tax on the gains and a 10% penalty tax. So it's learning how to avoid that. And every policy has what is called a MEC limit. We can set that wherever we want. A lot of people don't know that. So when we set up a policy, if you said, hey, I like this from a growth standpoint, I want to use it for my self-storage business, here's how much I think I can pay into the policy each year. Say it's $100,000 per year. What we would do is set that policy up in two ways. One, we would set that MEC limit. Think of it as a taxable line, the IRS maximum you can pay into the policy each year. We'd set that at $100,000. And then the next thing we would do is when you pay in that 100, you can actually choose how much of it goes toward the insurance premium and then how much of it goes toward that PUA rider, which all goes toward cash value, just about all of it in the first year. So people aren't aware of this for the most part, that we can shrink that premium down. All companies have different limits, but you'll see with the top companies, a lot of times they'll allow you to go as low as 10%. So we'll shrink the base premium down to 10%, call it. Now I'm committed to 10K, but I can pay up to 100K at my discretion. And if I'm a real estate investor, my cash flow, it comes in nice and consistent every month, no matter what, right? Not all the time, right? It fluctuates at times. So now if I come into a lump sum, if I sell a piece of property, I can take that, throw it into the policy at my discretion instead of having a boring bill where I pay the same amount every month or every year. A lot of info. Let me know if you have any follow-up questions there.
I'm tracking, and I'm assuming that everybody else is as well. So let's maybe take a different path, and that is tell us some of the either, and maybe it's just inherent in the way that you've and laid this all out. Is there any other, extra ways in which extra strategies or anything additional, and some of the, really cool ways that you've seen people use these policies to put together a particular transaction, or how somebody has used this strategy where you may not have seen anybody use it before? Tell me some of the wow stories, perhaps that you're aware of, and some really creative ways that people have used this strategy.
Yeah, definitely. So the first stage is always setting up that policy for maximum cash value and flexibility, so the policy doesn't feel like a burden. But then how we've seen people use it, I can give you a particular example. Gentleman who has a number of policies over the years. He's paid in a lot of money into cash value life insurance products with different companies, and he has had some sizable loan balances outstanding just from using the policies, particularly for real estate investments over time. That's his business. He's acquired a nice portfolio. The drawback is he's looking at the loan interest rates, and with both companies, they're right at 5%. And just in the marketplace, it's a bit high. Just when he looks at, I can get 3% elsewhere. Like, I get it, what I'm doing, my money's still at work, but the net internal rate of return is between 3 to 4%. So he's earning less than what he's paying. So what he did, what we ended up recommending is you can take a cash value life insurance policy and you can borrow directly against it. You can also take it to a third-party lender, a bank, assign the cash value as collateral. You're getting a line of credit from them, typically right at 3%. If it's for a business purpose, that also generates an easy tax deduction. So in short, we consolidated the policy loans he had with the insurance carrier. Banks will actually, if you have an existing loan balance, they'll pay it off. So now the loan transfers to them at a 3% cost to borrow now, while he's now earning between 3 to 4% at this point in time on his policies, doing the exact same thing for real estate. He just transferred the loan over to a lender for a lower rate, easy to generate a tax deduction because it's on the bank's paperwork. It's not easy to deduct the loan interest directly on life insurance policies. Some CPAs do it, but the IRS language states generally it's not something they like. So we don't like to mess with them. So it was nice just to take someone in a position where he was happy, but he was paying more interest than what he was earning, and just put him in a better position by leveraging assets that are available. Awareness.
Yeah. Well, regardless, I mean, what we've seen so far is the ability to borrow against it, and then you just use that as your down payment. But, what you're stating is, well, why do that and pay a higher rate on the policy than what a bank is going to charge you for their cost of capital? And so you just shift it and you get another loan from them. You do the paperwork and you get cheaper cost by collateralizing it and keeping it in the policy instead of taking it out. It's not even sneaky. It's straightforward because you're the professional. So I get it. But that makes a whole lot of sense. All right. So let's talk about, so now in the time that we have left, let's talk about maybe the pitfalls or some of the things that we haven't touched on, or, why this may not be the best avenue or strategy to take for somebody. Walk us through some of those, or some of the things that people, as they get into this, that they realize, oh, maybe that wasn't the best move. Go through some of those for us, if you would.
Absolutely. So I'll give you the biggest one. The worst part about any whole life insurance policy, no matter how well it's designed, this applies to individuals and especially corporations. You just have to give corporations your best foot up front. Otherwise, you're at the door and they're going to go to someone else. Is the worst year is the first year with a whole life insurance policy. When I pay money in, again, it can go toward the insurance premium or toward that PUA component, which builds cash value. Premium dollars with most traditional whole life insurance policies do not show up in cash value in the first year, sometimes the first and second year, meaning I'm going to have less money than what I pay into the policy in the first year. So really a quick sign to tell if it is designed similar to what corporations do, which view it as an asset on their balance sheet, they want it rich in equity immediately and long-term, is it should typically have anywhere between 80 to 90% of my payment in cash value in the first year. If that's done, that is a good indicator to know that that policy is set up with a premium as low as the company will allow one to contractually go. If I see less than that in cash value, I'd want to question it a bit more to know, okay, what's the intention here? Maybe I want to fund for a long period of time. Maybe it's a company that doesn't offer a product that has more upfront cash value. Should I then look at other options? But that is the number one issue that pops up with individuals, specifically when they start a policy, they have 50% or zero of what they paid in cash value in the first year. They're told it was the best option, and then find out after the fact they could have had more equity. And then you have a situation where you feel like, I asked if I could get more money, I was told no, and now I see something that provides that. That type of issue, that situation right there, it happens in all industries, but with whole life insurance particularly, it's happened for a long time. That, from an awareness perspective, is what we talk about all the time, because it's the biggest pain point of consumers. So that would be the number one thing.
Mm-hmm. Got it. All right. Well, Steve, this has been extremely enlightening, and I know that we could talk through many, many more scenarios. And if this is still unclear how and why people should be using this strategy, why don't you give us your information as to how they can learn a little bit more and how they can get in contact with you to maybe have you walk through this in a personal setting?
Sure. So our website's the best resource, ibcglobalinc.com. It is IBC Global LLC now, but it's still ibcglobalinc.com via the website. All of our contact information is there. You can also reach out to us via email, info@ibcglobalinc.com. And we've got a phone number too.
Fantastic. Well, Steve, as we talked before we hopped on this call, we were made aware of this strategy, many, many years ago. And there's a whole lot of folks that are familiar with the book, Becoming Your Own Banker, and then also The Bank on Yourself, and other books, and other folks have really, caught on to this and talked about this. So is there any other book that you would suggest that people may read, not only to learn perhaps about different strategies or using life insurance, but some of your favorite investing books or money books that you would recommend to the folks read, just expand their minds a little bit and understand that there are other ways out there to be able to not only invest, but then also use those investments to grow their portfolio?
Yeah, definitely. So when it comes to books, I can list a couple of them off. I love business, how to grow the business, whether you're looking at the intricate details or just concept. The two best books that I've read and listened to recently are on business building. One's behind me, Ready, Fire, Aim. That's fantastic. That's very detailed, right? So you be prepared to focus. And then the other is actually $100 Million Offers by Alex Hormozy. Yeah, short book, but excellent. The way he communicates is so clear, very easy for anyone to follow who's trying to really grow their business. You'll hear his story in there too. But those two businesses, if you're trying to figure out, hey, how do I get to that next level where I see other people just zooming ahead of me? It's like, I know I can do that, but why am I struggling with all these little things that chew up my time? Those two are a great starting point. If you want to start shorter, like not a in-depth book, Ready, Fire, Aim, that's a bit lengthy. Alex's book is great. $100 Million Offers. He did a good job with that.
And I appreciate both of those. We spend an awful lot of time here teaching everybody about the tools and what that looks like to, get into logistics, the nuts and bolts, the A to Z on investing. But boy, there is so much of this that is absolute mindset. And we talk about this, Ready, Fire, Aim. And we talk about folks that, come through our organization and our events where they aim. They aim and they aim and they aim and never pull the trigger, and recognizing that there's a different way of doing this, and then also putting out $100 million offers. Anything that writes, 100% agree with. The guy is he's got an incredible business mind, and he will absolutely get you fired up. And so I appreciate both of those. Those are both action-oriented, action-taking type books. I think would probably be the best way to characterize those. So I appreciate that, Steve. So anything else that you would like to share with our folks here before we sign off for the day?
I appreciate you asking. No, great questions. And I appreciate you having me. Thank you very much.
All right, Steve, thank you so much for your time today as well. We will include the link to the website and your contact information down in the show notes. Folks, please, as we're always looking for more and better and different ways to be able to affect the capital stack and to be able to put these projects together, this is absolutely a strategy that you need to take a look at. And that is why we brought Steve on, because he is one of the foremost experts. So go check him out. And with that, gang, we'll see you all on the next one. Take care. Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.